Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is February 27th, 2026. We've got a heavy slate of news today, from a paradoxical reaction to Nvidia's earnings to some significant shifts in the labor market driven by AI. Let's dive in. We start with the US markets, where the mood is decidedly cautious this morning. S&P 500 futures are down about 0.5%, and it looks like the index is on track to notch a monthly loss for February. The big culprit here is the Producer Price Index, or PPI. The data came in stronger than expected, which is a bit of a gut punch for those hoping the Federal Reserve would start cutting interest rates soon. When inflation at the wholesale level stays sticky, it usually means consumer prices will follow, keeping the Fed's hands tied. The Dow and the Nasdaq are also under pressure. Specifically, the Nasdaq is feeling the weight of the AI sector. Even though Nvidia posted blowout earnings, the stock actually dipped in the pre-market. It's a classic sell the news event where expectations were just so high that even a beat wasn't enough to sustain the rally. We're also seeing a sharp drop in Nvidia partner CoreWeave, which plunged following its own earnings report. On the small cap side, the Russell 2000 is struggling as higher-for-longer interest rate fears hit smaller companies with more debt exposure particularly hard.
Moving north to the TSX in Canada, we're seeing a similar wait-and-see approach. The Toronto Stock Exchange often takes its cue from the U.S. inflation narrative, but we also have to look at the energy sector, which is the backbone of the Canadian market. We're seeing some interesting movement in global oil, which is currently gaining ground as the U.S. and Iran agree to more nuclear talks. However, with the U.S. PPI data coming in hot, there's a concern that a stronger U.S. dollar might put a cap on commodity prices. In terms of top movers on the TSX, keep an eye on the materials and energy stocks. We are seeing some consolidation in the global energy space. Norway's Equinor is looking to sell off some Angolan fields to focus on Brazil and U.S. output, which signals a broader shift in where capital is flowing. For Canadian investors, the main focus today is whether the TSX can hold its support levels amidst this global volatility. If the U.S. tech rout continues, the tech-light TSX might actually outperform on a relative basis, but it's going to be a bumpy ride for the loonie.
Shifting across the Atlantic and over to Asia, the international picture is a mixed bag. In Europe, the FTSE 100 in London is watching a fascinating story with Rightmove. The property portal staged a last-minute rally that might just save it from being booted out of the blue-chip index during the upcoming reshuffle. Meanwhile, over in Germany, the DAX is digesting some positive news. Inflation there has slowed to 2%. That's the ECB's target, but the German economy is still recovering very slowly, which is why we're seeing manufacturers like BASF talk about intensifying cost-cutting measures. In Asia, the Nikkei and Hang Seng have been navigating their own headwinds. But the real story lately has been the Nifty 50 in India, which remains a favorite for emerging market investors even as capital flows are being rerouted. Interestingly, we're seeing Saudi Arabian investors aggressively moving capital into U.S. equities because their domestic market has been one of the world's worst performers this year. In the world of alternative assets, Bitcoin has been a roller coaster. It briefly crashed below $48,000 on an upstart exchange, but options traders are already betting on a rebound to $90,000. It's extreme fear meets extreme optimism.
Let's get into the big corporate stories in North America. First up, the Nvidia paradox. It's wild. The company is screaming growth, but because the earnings were so good and the price-to-earnings ratio is actually compressing, some analysts are calling it a value stock now. Retail investors aren't waiting around. They bought Nvidia in record numbers yesterday morning. In the software space, Salesforce is a bright spot. They beat earnings and, more importantly, committed a staggering $50 billion for stock buybacks. That's a massive show of confidence. On the flip side, we have a major shift in the streaming wars. Netflix has reportedly dropped its bid for Warner Bros. Discovery. This clears the path for Paramount Skydance to move forward with a $111 billion deal. And we have to talk about Jack Dorsey's block. They're cutting 4,000 employees, nearly half their workforce. Dorsey is calling this a bet on AI changing labor productivity. It's a stark reminder that while AI is a boon for chipmakers, it's leading to significant belt tightening in the fintech and software sectors as companies try to do more with less. Finally, Flutter, the parent company of FanDuel, issued revenue guidance that came in below what Wall Street was looking for, causing some jitters in the online gaming sector.
Looking at the international corporate landscape, we have some significant old economy news. Stellantis, the maker of Jeep and Chrysler, reported its first annual loss in company history. They took a massive hit from EV write-downs and have since scaled back their electric vehicle ambitions. It's a sign that the transition to EVs is proving much more expensive and slower than the industry anticipated. In Germany, the chemical giant BASF is in the middle of a major slump. Their CFO warned that 2026 income will be flat at best, leading to those cost cuts I mentioned earlier. On a more positive note, there's a massive copper boom brewing in Argentina. There's about $40 billion in investment on the line, but it all hinges on President Javier Milei's ability to revamp environmental laws regarding glaciers. If that goes through, Argentina could become a global copper powerhouse. Lastly, keep an eye on the EU's trade deal with the Mercosur group of South American countries. The EU is forging ahead with a provisional application of the deal, which could open up significant trade corridors despite resistance from some European lawmakers.
On the macro and geopolitical front, the eyes of the world are on the U.S. Treasury and the Department of Justice today. They face a deadline to decide on a major tariff refund case. This ties into the broader Trump trade narrative, as the president recently suggested that tariffs could eventually substantially replace federal income taxes. It's a radical policy shift that experts are still trying to model. Globally, there's a bit of a relief valve opening in Eastern Europe. Russia and Ukraine have agreed to a local truce specifically to allow repairs at the Zaporizhzhia nuclear power plant. While it's not a peace treaty, any stabilization around Europe's largest nuclear plant is welcomed by the markets. Meanwhile, OPEC Plus seems ready to defy the oil bears again, maintaining their grip on production levels despite warnings of surplus. Between the U.S. forces gathering in the Middle East and the upcoming nuclear talks with Iran, the geopolitical risk premium on oil isn't going away anytime soon.
To wrap things up for our investors today, here are the key takeaways. First, the AI trade is maturing. It's no longer enough to just beat earnings. The market is looking at how AI will actually reshape labor costs, as we saw with Block's massive layoffs. Second, inflation is proving to be a stubborn beast. The PPI data suggests that the Fed's higher for longer stance isn't just a threat, it's the current reality. Third, we're seeing a divergence in the auto and industrial sectors, particularly with the struggle of EVs at Stellantis and the chemical slump at BASF. Investors might want to look for quality and cash flow, like we saw with the Salesforce buyback announcement. And finally, keep an eye on the risk-on sentiment in crypto. Despite the volatility, the professional traders are positioning for a big move.
That wraps up today's update. I hope you gained useful insights to navigate the opening bell.
Add your thoughts in the comments and follow us for more such updates. This is Sarah
And Joe, signing off.